little bonus coverage here. So we published this on Friday broadly to just to help investors understand a couple things. One, we spend a lot of time talking about behavior heuristics here at 42 Macro. We spend a lot of time trying to coach investor process, not necessarily telling you what we think is going to happen in asset markets, what we think is going to happen in the economy, because obviously we tell you that that's what you guys are paying us for. But, we also, I've spent my entire career flying around the world, visiting some of the most thoughtful, smart people in the world from the perspective of managing financial market risk. We've had great discussions, great debates. I've learned a lot from them. They've learned a lot from myself as well. And what you see at 42 Macro is the sort of summary of all that knowledge in terms of the processes that we've developed and the tools that we've built. So one of the things that I think is really core to what it is that we do here at 42 Macro is a real distinct focus on behavior economics, and we weave that into all of our investment processes, specifically on the research side and also on the risk management side. So we wanted to leave you with this. This is a list and details of common behavior heuristics that prevent investors from achieving their strategic investment objectives, which if you're a retail investor, in our opinion, your only strategic investment objective should be to retire on time and comfortably. If you're an investment advisor, your strategic investment objective should be to help your clients retire on time and comfortably. And then obviously, if you're an institutional investor, your strategic investment objective is to generate more alpha than the next guy or gal, in terms of that you're competing with. So that's our view. So we'll let you review these in behavior heuristics on your own. In fact, I'll just kind of highlight my two favorites from each of these slides. So my first favorite from this slide is actually my favorite from each slide is actually the first bias. The action bias describes our tendency to favor action over inaction, and this is something that a lot of investors struggle with on the retail side and on the institutional side is over trading. Overtrading their portfolio, having more turnover than is necessary to achieve those strategic investment objectives. And our solution to that is having clear risk management signals that communicate do nothing when there's no change in signal and take action only when the signal changes. We can watch the evolution of our fundamental research summary migrate from overwhelmingly bullish to not as bullish to starting to get bearish to very bearish. But if we don't get out of a risk on reflation market regime, then who cares? My job is not to respond to that stuff. My job is to respond to the clear risk management signals that tell you to change your portfolio. And so I just want to make sure again, separate your research from your risk management. Your research can be getting more bearish or more bullish from my pen is a dial here, super bullish to super bearish. But if the risk management signals, particularly the market regime or KISS or a discretionary risk management overlay, don't change signal, then you should not take action in your portfolio. Don't overtrade based on your emotions or your gut or your assessment of the future, because again, we're all terrible at predicting the future, including myself. Every investor, every human being in the world is terrible at predicting the future. The most important thing that's happened in the last half decade is the overwhelming, in terms of the economy and asset markets, is the overwhelming response to COVID that we had from U.S. fiscal monetary policymakers. We grew the federal debt in terms of the incremental deficits we added by $6 trillion between the start of 2020 and the end of 2021, and the Fed monetized 52% of that $6 trillion. No one in history, no one in the world predicted that. You ask anybody on December 31st, 2019, if the Fed and Treasury were going to, the Treasury was going to issue $6 trillion on a net basis, and the Fed was going to sponsor 52% of that on its balance sheet. Not one person in the world would have told you that on December 31st, 2019. And this is the most important thing that has happened in the US and global economy in the last half decade, and in terms of asset markets as well. And we're still dealing with the legacy of that today. So if the most important thing that's happened to the economy and asset markets in the last half decade was something that 0% of investors predicted, then you should not be relying on predictions, which takes me to my favorite from this slide before we wrap up, which is the illusion of validity. The illusion of validity is a cognitive bias that describes our tendency to be overconfident in the accuracy of our judgments. We replace judgments with predictions, and specifically in our interpretations and predictions regarding a given data set. And so again, we think we know how the world works from a piecing the growth inflation policy puzzle together. There's obviously things we're going to learn and continue to improve on over time. But even with that institutional knowledge base, we are not overly reliant on predictions. And in fact, our solution to this is an institutional research process that is heavy on observation, and light on predictions. We don't want to be we don't want our predictions to be responsible for outcomes in your portfolio. We want our risk management process to be responsible for outcomes in our clients' portfolios, because that is a better way to invest. When we do make predictions, they're generated by models that apply proven quantitative techniques to time series that span multiple economic and market cycles, while also quantifying and publishing our error rate on each of our econometric models. So again, if you hear one thing from me this week, and if you hear one thing from me before I die, is that the best investors in the world rely on observation and changes in signal to change their portfolio, rather than changes in their predictions of what's going to happen in the future. Because guess what? Everyone sucks at predicting the future. And the second you accept that is the second you're going to make yourself a better investor, and ultimately make more money in financial markets.